Hello, my name is Mark Wolfinger, and I want to welcome you to this very basic, very introductory course at Options for Rookies Premium. This video is intended for people who have zero or very little experience with options. It's very basic. I'm going to go over a bunch of topics, but I don't plan to go into any of them into extreme details because that's for next time. That's for a more advanced lesson. Here, I want to make sure that those of you who have no background in options know enough to get off to a better start and be able to then come back and listen to each of these topics in greater detail and have a better understanding. I know that I could go as my textbook does and give each separate chapter in enough detail that you won't have to go back again, but this time I'm trying to do a brief overview for people who have no experience with options. So with that, let's get started. What is an option? How does an option work? The two very basic questions. An option is an agreement. It's a legal binding contract between two people. There's a buyer and a seller. One buys the option and pays a price called the premium, just as an insurance company uses that term, a premium. Buyer pays the premium to the seller. In return for that, the buyer, who now owns the options contract, has certain rights, and the seller may incur certain obligations. Those obligations are specified, but many times the seller is never called upon to honor those obligations, and we will discuss those. So basically, what does an option do? An option, as I said, gives the owner certain rights. If you have a call option, and there are two types of options, calls and puts. If you have the call option, you have the right to buy a certain item at a certain price for a limited period of time. And I'll show you how that works in a real-world example in just a moment. If you have or own or buy a put option, you have the right to sell a specific item at a specific price for a limited period of time. And it really is as simple as it sounds. Or if it sounds complicated, then let me assure you that it's not. You've been using options probably all your adult lives. So here's a specific example of a call option that you've been using and why you should already understand how it works because you've been using it. You may see an ad in a grocery store to offer for sale a certain item that you like to use at a sale price. Let's say it's a pound of coffee for, if the regular price is $5, they're offering a pound of coffee at $3.50, a bargain price. So you want to buy some. Or, I don't want to confuse you with another example, or you may find that the pizza shop that you normally go to has an ad in the newspaper, as they frequently do, for $3 off. Well, that $3 off coupon works as a call option, and here's how it works. Let's say you go to the grocery store, and you want to buy this coffee at $3 a pound, and they're all sold out. This was a great sale and are all sold out. So you go to the customer service department and you ask for a rain check. The person who's working there fills out a piece of paper and it gives you the right to come back to that store anytime before that rain check expires, and that will either be 2 weeks or 30 days depending on the store's policy, and they will grant you the right to buy X pounds. They'll ask you how many pounds of coffee you want, and let's say you say 3 pounds. They'll give you the right to buy 3 pounds of coffee at $3.50 a pound, regardless of the selling price in the market, regardless of the real price. So you have the right to return to the store to buy something specific, 1, 2, or 3 pounds of this coffee at the price of $3.50 any time before that rain check expires. Well, it's the same thing at the pizza shop. You can go in and buy a pizza, but you can also hand them your coupon from the newspaper, which gives you the right to buy that same pizza and get a $3 discount anytime before that coupon expires. Those are rain checks or coupons, and they work exactly as a call option does. When we deal with a call option in the stock market, the only difference is you can't get those for free. You have to buy them. But a call option gives you the right to buy 100 shares of stock, the same way it gives you the right to buy 3 pounds of coffee at a specific price. Or with the coffee, it's $3.50 a pound. In the stock market, in the world we're working with, that specific price is known as the strike price. You have the right to buy 100 shares of stock at the strike price for a limited period of time. Yes, your rain check has an expiration date, and so does your call option. And I don't want to get into it right now, but the call options have specified expiration dates. Options are standardized so that basically all options expire at the same time, so you don't have to worry about one is July 13th and one is July 15th and one is July 19th. If you have a July option, you'll know when expiration is. So options are standardized, and that's really what it is. You have a rain check that gives you the right to go to that grocery store and buy 3 pounds of coffee at the strike price or the sale price for a limited period of time, and that's a call option. If you understand how a rain check works, you understand how a call option works. And a put option is not quite as common in our lives. What I mean to say, a put option is not exactly the same as it is with a stock put option, but it's very similar. If you have an insurance policy, let's say on your car or a piece of jewelry or fire insurance on your house, well, let's look at the car. You have an insurance policy on your car. There's lots of parts of that policy, but the one I want to focus on is if that car is totaled, destroyed, stolen, lost, if it has no value to you, but the replacement value of the policy is worth more than, you can't fix the car, it's too expensive, this car is totaled. Or like I said, stolen and never recovered. You have the right to sell a specific item, your car, back to the insurance company at the strike price, the amount for which it's insured, the face value of the policy, for a limited period of time. And for car insurance, it's normally a year. And for stock options, it's not. But it doesn't matter what the length of time is. When you buy a put option, you have the right to sell 100 shares of stock instead of a car, or a lost necklace, or a house that's burned down, back to the insurance company. Well, you have the right to sell that 100 shares to someone who sold a put option. And you can make them pay the strike price. You can make the insurance company pay the face value of the policy. Despite the fact that the car is worthless, or despite the fact that the stock is trading at a much lower price, you have the right to sell it at the higher price. And you have that right for a limited period of time until the option expires. Now you may ask, okay, I have the right to sell a stock trading at $30. I have the right to sell it at $45 per share, but who's going to buy that? How can I enforce my rights? Well, that's part of the contract. The person on the other side of that contract, which is someone who sold that contract, it doesn't have to be the specific person who sold it to you, it's anyone who sold it, has obligations. We talked about those before. There's an obligation. If you do what your contract allows, and the term for that is exercise, and we'll get to that. If you do what your options contract allows and elect to sell 100 shares of stock at $45 per share, according to the contract value, the other person is obligated to pay you $4,500 a share. And it's not like there's an argument or there's a discussion. You just notify your clearing firm or your broker that you want to, exercise that option. You notify the broker, and that option is automatically exercised, and it goes into a giant pot, and somebody is randomly assigned, someone who sold that option, the notice that you exercised, and this person has been chosen and must honor the conditions of the contract. So this person is going to have the stock added to his or her account and $4,500 to pay for the shares removed, and that's going to happen at night when the markets are closed, and the next morning, that person, he or she, is going to discover 100 shares of stock and $45 gone. In other words, it's a done deal. It can't be reversed. There was an obligation to honor the contract, and this person was chosen to honor it, and it's done. From your point of view, you no longer have the shares in your account, but you have $4,500 instead, less any commission that the broker may charge to make this transaction for you. So that's really what a call option is. It's the right to buy, and it's guaranteed. The other person cannot decide not to honor the contract. And if you sell an option, you make a commitment, and you may be called upon to honor that commitment. And you have no choice in the matter. It doesn't matter if you're bankrupt. It doesn't matter anything. We have what's called the OCC. It used to be called the Options Clearing Corporation. What you really need to know about them is that they basically guarantee all options will be honored. You don't have to worry about the financial ability or capability of the person with whom you traded. You buy or sell an option, it's guaranteed. You will get what's coming to you if you choose to do what the contract allows, if you choose to exercise your option. So, it's really, as I say, that simple. So let's see how you would do this in the real world. Let's say you have a rain check that allows you to go to the grocery store and buy 3 pounds of coffee. 2 weeks pass and you go back to the store and you discover that, yes, this coffee is back on sale. It's $5 a pound, but you have your rain check. You have the call option that gives you the right to buy it at $3.50. When you're in this store, I suggest that you not call it a call option because no one will know what you're talking about. But it is a rain check. And that gives you the same effect as a call option because it is a call option. So you go to the shelf, you put 3 cans in your shopping cart, you trot up to the aisle, and you put your coffee on the belt, and you hand your rain check to the man or woman who is doing the checking out. And what you are doing by handing that notice, handing that rain check, is you are exercising your option. And although we haven't used this term yet, we will, that cashier is being assigned an exercise notice, is being notified that someone who has a call option, rain check, is exercising it and demanding that the contract be honored. So that cashier will bring up 3 cans of coffee, charging you $3.50 each, honoring the store's obligation to deliver those shares to you, regardless of the current price, at the agreed-upon price or the strike price, because you have a binding contract. And that's all there is to it to make your call option come true. You have the right to buy, and you exercise your option and do buy. It's that simple. But there are other alternatives. When you own an option, you're not obligated to exercise. In fact, exercising is probably something you will do very seldom, if ever. When you own an option, that's a call option or a put option, there's no need to exercise to get your money out. In the grocery store, it's very difficult. In the grocery store, you really have to exercise and take delivery of your coffee if you want to get value out of your option. But when you're dealing with a stock option, you can sell it. Just as you bought it, you can sell it. And if the stock was trading at $3.50 at the time you bought it, and then has moved up to $5, well, you're going to have a profit on your call item, on your call option. You're going to sell it at a profit. Well, that's the same thing as buying the coffee at a discount. But let's say you're in the grocery store and you've changed your mind. In the 2 weeks you've waited before you come back to the store, you don't use this coffee anymore. You've changed brands, or you've decided caffeine is not good for you. It doesn't really matter. You no longer want this coffee, but you've got this nice rain check which lets you buy it at $3.50 when it's selling at $5, and you can't do anything with it. But if you happen to notice someone buying a pound of that coffee, you can turn to that person and say, hey, listen, I've got something here. I've got a rain check that lets you buy 3 pounds of this coffee and save $1.50 a pound. That's worth $4.50 to you. I tell you what, I'll split it with you. I'll sell it for $2.25. You'll save $2.25. I'll get $2.25. We'll each come out ahead. Now, if you have somebody who doesn't just distrust everybody, this person will recognize that it's a regular store rain check, and that person can make $2.25. And instead of buying the 1 pound of coffee, he or she will buy 3 pounds of coffee and take this deal. So what you've done is you've transferred your rights. You no longer own the call option. You no longer have any rights. You can no longer buy coffee at the agreed upon price, but you've sold your cost. You've sold your option, and you've taken a profit of $2.25. Now, this other person may be even more sophisticated and say to you, well, I can see you're not buying the coffee. That's worthless to you. Why should I pay you $2.25? It's worth nothing to you. I'll only give you $2 or $1.50. Well, if that happens, now you've got a bargain. You've got a bid price. You've got an ask price. You have someone who wants to buy. You have someone who wants to sell. If they can agree on a price, there'll be a transaction. That price would be the premium. If they can agree on a price, you'll sell, and this person will buy. I'm hoping it'll be $2.25 for all fairness, but in reality, it doesn't have to be. It can be anything. It can be anything more. You can even be a hard nose and say, I'll sell it at $3. But nobody should really pay that because they know it's worthless to you. However, in theory, even though this is an unlikely event, you can sell your option if you find a buyer. When you're on the options exchange and you have an option that's trading back and forth and there's some volume in it and there's interest in it, you'll be able to sell it with no problem. You may not be able to get your price. You may have to negotiate the price, but you can sell it with no problem. So when you own an option, one of the things you can do with it is sell it. You can also exercise it, as I said earlier. And the third thing that you can do with an option is to allow it to expire and it becomes worthless. You've lost whatever value it had. You've lost anything that you paid for it. Your rights have expired with the option, and the obligations of the option seller have also expired when the option expired, so there are no longer any rights or obligations. Well, when would you let the option expire worthless? Well, when it has no value. So, for example, you go back to the store intending to buy that coffee at $3.50, but you discover, maybe at the same store or even a different store, that you find this coffee on sale for $3.25. Well, you have the right to pay $3.50 per pound. But what good is the right to pay $3.50 when you can buy it at $3.25? So you buy it at $3.25, and this rain check doesn't really have any value. At least not today. You buy it at $3.25 and you keep the rain check. If, before the rain check expires, the coffee is back to $5 a pound, maybe you can find someone to sell it to. So maybe an option that appeared to be worthless will have some value and you'll be able to sell it later. But right now, it's worthless. And if the coffee stays on sale at $3.25, then when expiration comes, nobody will have any interest in paying $3.50 per pound because you can buy it for less and the option is worthless. And it's the same way with the stock market. If you have the right to buy 100 shares of stock at $40 a share, if the stock is trading at 39 or 38 or 9, and even if it's trading at $39.50, which is close, why would anyone care that you want to sell them the right to buy it at 40? There's no reason to pay 40 when they can buy it at $39.50. And now we're talking about right expiration day, right when it's time for this option to expire. We're not talking about earlier. There's plenty of reason to buy options before expiration. But if options are going to stop trading at the end of today and it's 10 minutes before the close and the stock is $39.50, anyone who wants to buy stock will pay $39.50. They don't need your 40. So it's worthless. Time has run out. The stock is below the strike price. This option is going to expire worthless. So those are three things you can do with an option. You can exercise it and do what the contract allows. You can let it expire worthless, or you can sell it. I hope that basic understanding is clear to you. Just as you can use a rain check, or just as you can use an insurance policy, you can buy or sell call and put options. The question arises, why would anyone want to buy a call option or put option, and why would anyone want to sell it? And that's a discussion that comes later. I want to give you a little bit more background about options. Why does the options market exist? How does anyone know what to pay for an option? Now, these are all fundamental basics. The option market exists to spread risk. Original options that go back to biblical times were really bought and sold as a risk spreader, as a risk mover. Someone didn't want to take risk, transferred the risk to someone else, and had to pay a premium for that. An early example were the big shipping companies who sent ships out into the oceans, never knowing if they'd return or not. We didn't have maps of the world. They weren't complete. Going out onto the high seas was dangerous. So there was a chance the whole ship would be lost and not come back. Well, there were people who would give you an option on the value of your cargo or the value of your ship. In other words, you pay them a premium and they guarantee to pay you if the ship is lost at sea. It's an insurance policy, but it really was an option. So the options are made to transfer risk. You don't want risk, you give it to someone else and pay them. And they will take that risk in return for being paid a premium. But there's all kinds of reasons for using options. The two primary reasons are to hedge, reduce risk. The other is to speculate, gamble. There's a lot of speculation with the options markets. Most beginners learn, if they don't really come at it from a good educational source, to just buy options on a gamble. Buy puts, buy calls, expecting the stock to move. And even when the stock moves their way, they don't necessarily make any money. And I realize I haven't described what their way means yet. I'm just talking in broad terms. So you can speculate by buying and selling options, or you can hedge. Hedge really means reduce the risk of owning. Options are fantastic tools for hedging. They allow you to own various positions with reduced risk. Now, with that reduced risk comes the offset of reduced profit potential. For most players in the options market, that's a great trade-off. I'll take less risk, and I'll have a chance for less reward. But that's okay. Others say, no, that's not okay. I want to really make a lot of money. This stock's going to double, and I want to make many, many thousands of dollars, and I'm going to gamble it out. I'm going to take my chance. I'm not going to hedge. I'm not going to reduce my upside. So using options to hedge is not for everyone. But it is a standard reason for why the options markets exist. Now, how is an option valued? How are we going to know what to buy or sell, what to pay? Well, we have a calculator based on the Black-Scholes model. Myron Black, Myron Scholes, and Fisher Black in 1973 published the first equation, the first model for being able to value an option. And that came out right at the same time that the Chicago Board Options Exchange opened, which is really excellent timing. We have options trading plus some way to value them, and the information is all available when it's needed. Now, over the years, this Black-Scholes model has been refined. First, it didn't account for dividends, and then there's two different types of options depending on expiration rules. We don't have to get into that yet. But the point is, we have more sophisticated option calculators that take into consideration a whole lot more information than the original Black-Scholes model, which still has some value and is still used by some people. The point is, the mathematics may be complicated, but the application is simple. Every broker plus many online sites offer a calculator that you can use to estimate the value of an option. So you always have a fair idea of what an option is worth. Now, sometimes options will be priced higher, and sometimes they'll be priced lower, and people have lower or higher than the fair value. But that fair value is an estimate based on opinions, so there's never really an exact fair value that you can say, this option is worth this, and I'm going to bet on it. I mean, you can bet on it by trading against your expected fair value, but others will disagree, and that's why we'll have anxious buyers and anxious sellers because they don't agree on the value. But you can calculate the value of an option by putting in certain parameters. I'm going to just mention them now. I'm certainly not going to talk about this in depth now. But the things that count in evaluating what an option is worth are whether it's a call or a put, the stock price, the strike price of the option, interest rates play a factor, whether the stock pays a dividend matters, how much time there is before the option expires, and the volatility of the underlying stock. Stocks that move a lot, stocks that are volatile, they have more expensive options. Stocks that are very stodgy and steady and move very slowly, well, they have very low-priced options. And we'll get into all of that, not in this video, but as you learn more and more about options. Again, the basics here, the basic idea here is to get you to understand the background so that you can progress into a more advanced video and take part in the discussions that we're having in our live sessions so that you can understand more of what's happening and ask intelligent questions and continue with your education. And that's why I'm here, to help you with that education. Now, one thing that options do that no other investment tool does, and it's what makes them special, it's what makes me passionate about them, it's what makes me understand that options have an advantage over anything else that's out there. I mean, it's better than trading stock, it's better than trading commodities, it's better than trading futures and forex and currencies, depending on how you look at it. But for me, there's only one way to look at it. Options let you measure risk of any position. When you measure risk, you have the choice of deciding, this is too much risk, I'm going to reduce it, or not, and accepting the risk. But when you buy a commodity, a futures contract, or when you buy a stock, you really know that your risk is $100 per point for a stock if it heads down, and your reward is $100 per point if it moves higher. That's pretty clear and in front of you, but there's no adjustments. There's nothing you can do. If you want to hedge some of that risk in the stock, if you own 500 shares, okay, you can sell 200 shares. Now you have less risk. So that's a hedge, and that is something you can do. But options are much more sophisticated than that, because options have special properties. When we have a position, an investment that consists of options, we can measure the rate at which the value of this position changes over time, every day. I'll tell you that options tend to lose value as time goes by. That means we're wasting asset. So that as time passes, options tend to be worth less unless something happens to increase the value of the option. But we can measure our risk of holding for a day or our reward for holding for a day. We can measure how long or short we are. When we buy 300 shares of stock, we know we're long 300 shares. But when we have a collection of options or a single option, we can check the delta. We can check the share equivalency. Our position is expected to act the same as 237 shares of stock. And over a narrow trading range, that's exactly what will happen. If the stock goes up $1, all things being equal, we can expect to make about $237. And if it drops 2 points, we can expect to lose 2 times that, or $474. So we can measure that risk. If we decide that we have too much exposure, that that's too many delta to be long or short, too many share equivalents to be long or short, we can fix our position by doing something that gives us short delta. We can buy short delta or we can sell long delta, but the point is we can use options to reduce that risk. Another thing we can measure is the rate at which that share equivalent changes. As I said, it wasn't constant. We may have a position in which we're long 237 shares at this point, but if the stock moves higher, we now may be longer. We may be long 300 shares. That means we not only made money as the stock moved up, but if it moves up more, we're going to make even more because we're longer. I don't know if that makes sense, but shares are shares and they don't change. But options have properties that make the share equivalency change as the stock price changes. And the measure we use to describe that is gamma. It's what measures the rate at which the share equivalency changes. So by knowing that, if we have too much risk or too little reward, we can change. We can buy some gamma or sell some gamma. So it's important to know and measure these risk parameters. We can know how much the value of our position will change if interest rates change. Okay, that's minor. Interest rates are not likely to change much, and certainly not over a short period of time, and that doesn't really count a whole lot, especially in today's world where interest rates are low. But we can measure our exposure to interest rates if you want to get sophisticated and count that. We can also measure our exposure to a change in market volatility. When markets are more volatile, options all tend to become higher priced. People expect larger moves or are afraid of large down moves, and they're anxious to buy options to hedge their position. And that's true for both puts and calls. They tend to buy options. That means the volatility used in the equation to estimate the value of an option is raised and the value of an option goes up. So we have exposure. And when you have options, you can measure the vega. And all that means is, I'm trying to keep this simple now, but all that means is if the volatility changes, you can estimate how much you'll make or lose if the volatility goes up by 1 point. Now, we haven't discussed volatility and how it's measured, but it's generally a number in the range of 20 to 60. I mean, it can be anything. But the point is, if it goes from 20 to 21, that's an increase of 1 point. If it goes from 60 to 61, that's an increase of 1 point. You can estimate how much your position will make or lose. So you can combine all of these things. You can look at the share equivalency. You can look at the rate at which the shares will change. You can look at the rate the interest rate will change. You can look at the time decay. And you can look at your exposure to a change in market volatility. And if any of those risks seems too high, well, you can make a simple trade with options to reduce that risk. And that's what makes options so great. You can reduce risk when you want to, but at other times you can measure that risk and have a rough approximation of what you're going to make if the stock does this, or if the market does this, or if the volatility changes this. None of these changes are exact because they're all based on an estimate. Nevertheless, they're good enough to be a first order of magnitude understanding of what your exposure is, how much you can lose. We're not normally concerned with how much you can gain. Of course, that's important. But what's most important is how much you can lose and making sure you keep those losses under control. So in trading options, it's my basic philosophy that gains are great and you want to obviously have gains. But to succeed, you want to take some losses because that's important, to not let positions run against you just because they're at a loss. But your goal as a risk manager is to avoid large losses. And options give you the ability to measure risk and to control that risk. And if you'll notice, the letters, the descriptive terms that I use, delta, gamma, rho, vega, theta, are Greek letters. Even though vega is not really a Greek letter, it's still, all of these are referred to as the Greeks. The Greeks are what we use to measure and manage risk with options. And you will want to learn about them. I'll tell you, you can skip it if you want, but that would be a very sad mistake on your part, because managing risk is what the options trading game is all about. So options are special in that they allow you to measure and manage risk, and they're special and different because they're wasting assets. Almost everything else that you traded in or invested in doesn't disappear. If you own stock, you own it forever unless the company goes bankrupt. Options have limited lifetimes, and they eventually expire. So we've talked about what an option is, what you can do with an option. I didn't talk to you about the two basic types of options. There's a call option, there's a put option. I gave you the definition, but let's go back and look at it a little more. Call option gives you the right, and we always add the phrase, but not the obligation. In other words, it's strictly up to you. It gives you the right to buy 100 shares of the specified stock at the strike price for a limited period of time. So, for example, you might own an option that gives you the right to buy 100 shares of IBM at $165 per share anytime for the next 3 weeks. Well, okay, that's fine, but how does anyone know that option? How does that know which option you're talking about? If you want to buy or sell an option, you certainly want to sell the specific option you have in mind. Well, to do that, we describe options. We need 4 pieces of information. The first information is whether the option is a call or a put. The second piece of information is the name of the underlying asset, and for that we use the stock symbol, IBM, GOOG for Google. We can also work with an ETF, that's an exchange-traded fund, like you've heard of the spiders. SPY, that's an exchange-traded fund that tries to mimic the performance of the Standard & Poor's 500. So SPY could be one of the underlying assets. Or you might even trade the index itself, SPX options. The point is you have to identify the symbol of the stock, the underlying asset. Next, you have to identify the strike price. The fact that you have the right to buy 100 shares of IBM doesn't mean anything unless I know what you have to pay. If you, in the example I just mentioned, you have the right to buy 100 shares at $165 per share. But there are other options They give you the right to buy at 170 or 150 or 180. And they all have different values. I think it should be obvious that the right to buy at 160 is more valuable than the right to buy at 170. If you can pay $16,000 for 100 shares of stock, that option has got to be more valuable than the right to pay $17,000 for 100 shares of stock. But even if that's not immediately obvious, let's cancel that because we don't have to talk about that right now. So you have to describe your option. So the last thing that we need is when does it expire? How long is this option good? And the basic answer, now there have been exceptions in recent times, but the basic answer has been from the beginning of listed trading on an exchange is the third Friday of the month specified. In other words, the IBM July 165 call, that would be the third Friday of July would be the last day that the options trade. That's referred to as Expiration Friday. In reality, in legalese, the options expire Saturday morning, the next day, the Saturday after the third Friday. But for all practical purposes, as a trader, you can consider the options as expiring when the market closes at the end of the day on Friday. And that is the time, well, we actually have a little extra because of Saturday morning. We have an extra half hour to decide whether we want to exercise any options we still own or let them expire worthless. Now, that decision has, for the most part, been taken out of our hands. Options are now automatically exercised for you, and this in itself is its own little discussion, so I don't want to do it now, but I just want to tell you that as far as you're concerned in describing an option, you can assume that that option is good until the morning after that third Friday of the month, but it stops trading on that third Friday of the month. As an aside, I will tell you that some options stop trading in the morning on Friday instead of in the afternoon at the end of trading, but those are few. Some options expire not just on the third Friday, but every Friday because now they've introduced weeklies options. So that's sort of a new innovation. We also have quarterlies options that expire on the last business calendar day of the quarter. And I know these sound grammatically incorrect, but the term is officially quarterlies options, not quarterly options, and weeklies options. So pardon the grammar, that's the official nomenclature. So to describe an option, you must describe call or put, stock symbol, strike price, expiration. And because we have so many expirations now, we no longer describe them just with July. Your broker may require, or it's better for you to do July 15th and the year, 10 or 11 or 12. So, for example, the option I described could be the IBM July 2011, that would be July 20th, 2011, 165 call. IBM is the symbol, July is the expiration month, 20 is the expiration date. That would be the Friday, not the Saturday. That would be Friday of expiration. 11 would be the year, 2011, and call. We also might have a Honeywell October 40 put. This option gives you the right to sell, because it's a put option, 100 shares of Honeywell stock at the price of $40 per share anytime before, I already forgot what I said, August, and whatever the date would be, might be August 18th, 2012, and it's put. So the point is you need to know whether it's a call or put, the name of the stock, the expiration month, and then specifically the day and the year, which is not always added when there's only one expiration in a month. They don't always have to add the day and the year, but a lot of people are doing that just for safety's sake. So that's all you need to describe an option. So if you call your broker or enter an order online and you tell the broker, again, verbally or online, I want to buy 3 Google November 600 puts, then that's understood to mean that you want to buy 3 options that give you the right to sell 100 shares of Google for each option at the strike price 600 anytime before the option expires in that month, which is after the third Friday. So when you know how to describe an option, you can enter an order to buy or sell. So far we've looked at how to buy or sell? Well, we looked at what an option is, how an option works, how to derive the value of an option, even though we haven't gone into any detail. We've looked at why you have to describe the option and all its parts. We've looked at the fact that options can use the Greek letters to describe risk, and then you can manage the risk. That's all good. It's all basic, solid information that you need to know to trade options. One other thing that's important, of course, is what is a call, what is a put, and why would you want to buy one? Okay, well, a call option gives you the right to buy 100 shares of stock. A call option has a positive delta, and all that means is when you own a call option, you have the equivalent position to some number of shares of stock. And when stock moves higher, stock is worth more. And so, barring outside considerations which can change the minute details, when you own a call option, if the stock moves higher, the call option moves higher. And if the stock moves far enough, the call option moves far enough, and you can have a very large profit compared to the price you paid. Similarly, well, no, let's just continue with that. If you have the right to buy stock at 40, and the stock is currently trading at 35, this option has a certain value. If it's expiration day, it has no value because time has run out, and the stock's not going to get to 40 in the next 5 minutes, and so it has no value. It's worthless. But if there's time remaining, a month or two, then there's a chance the stock can still get to 40 and beyond. So the option has value. Now think about it. If the stock moves to 37, well, there's a greater chance that this option will move through 40 and beyond, where it will have increased and ever-increasing value. So that option, whatever price it had at 35, is going to have a larger price at 37, a larger value. And if the stock moves to 39, the option increases in price again. So we have, other things being equal, as the stock price moves higher, the call moves higher because there's more demand for it. There's a better chance that it will be worth something in the future, not necessarily at expiration date. We are not forced to hold options until expiration date. We may plan to sell them tomorrow or in a week. But the point is, the higher the stock price, the greater the likelihood that the option will increase in value. And we're talking about when the stock is below that strike price. As you can see in this light purple line, as the stock price, which is the x-axis, moves higher, the value of the call increases, and the rate at which it increases. We'll talk about that another time, but you get longer and longer as the stock moves up, and that's the effect of delta. When expiration arrives, the option loses all of its time premium, so is worth less. Say at 28, it would be worth down here with a small loss compared with where it is now. It's worth more. But that's the loss of time decay. Ignoring that for the moment, you can see here that as the stock price goes higher, the value of an option increases. And as I said, sometimes there are other factors. One of those other factors is time. If too much time goes by, then instead of being worth along this graph, the value of the option is only along this graph. So there are competing factors, but in general, as the stock price moves higher, the call is worth more. As the stock price moves lower, a put is worth more. Once the option is way above the strike price, let's say the stock moves to 50, and you have the right to buy it at 40. Well, you can exercise this option at 40 and immediately turn around and sell the stock at 50. 100 shares, that's $1,000. So that option is going to be trading for at least $1,000. Now, you don't have to exercise it to buy the stock and then sell the stock. You can just sell your option, and it will be trading for $10 or more. There's reasons why it might be or more. But so you don't have to ever exercise your option. You can just sell it, collect your $10 with $1,000, and just take your profit. Presumably, you paid a lot less than that. But when the stock is worth $10, there's a chance the stock could fall down. This option may only be worth 8 or 7 or 6. So at all times, as the stock moves higher, the option will be worth more. All things being equal, in other words, not a lot of time has passed. If the stock is below the strike price and so much time passes, there may not be much chance that it can move above the strike price. So it may become worthless. And we have to talk about options and their comparison with the strike price. That's the last thing I want to cover in this introductory tape. So as an option moves up, a call increases in value. Again, other things being equal, because we have, in addition to the delta, which is owning an option, you own share equivalents, we have other factors. Time decay works against you, and vega, the effective volatility change, may work against you or for you. So we have to consider these other things. But in general, as the stock moves higher, the call option moves higher. But you have to understand that that's not always true all the time. So if you buy a put option, it works exactly the same way in the mirror image. You want the stock to decline. You have the right to sell at a certain price. And if the stock moves to that price and lower and lower and lower, then the value of your put option is worth more and more and more. Puts have negative delta. Puts act as a negative share equivalent, in other words, as if you were short shares of stock. So you want calls to go up, you want the market to go up, so calls will go up. When you own puts, you want the market to go down, so your puts will increase in value. Now that's the basic, simplistic term. We generally trade options in combinations and pairs. We call those spreads. We'll buy some of these, we'll sell some of those, but that's a little complicated to hear. It's really not complicated once you get past the beginning part. So we've talked about why you would want to buy a call option. And the answer is because you're hoping that the stock will move in your direction. You're hoping that a small investment will become worth a lot more when the stock moves higher. Or if you buy a put while the stock moves lower, you hope to increase your value. You understand that options have a limited lifetime, and at some point, they can be completely worthless. So buying an option, even though it's a limited risk strategy, you can lose 100% of your investment much of the time. And for me, that's important. People who talk about buying options always say it's not risky because it's a limited risk. You can only lose the money you paid for your option. You can't lose any more than that. If you pay $200 for an option, for a call option, no matter how low the stock goes, well, this option was worth $200. It can't ever be worth less than zero, so the most you can lose is $200. But you could make $1,000, $2,000, $3,000. There's no theoretical limit on what you can earn if the stock really screams higher. So that's why you might want to buy an option. But I need you to understand that I consider this to be a high-risk strategy because it's difficult to predict when the stock is going to move higher. And you have to get the when right because there's a limited time for this option lifetime. And it's difficult to predict that the stock's going to go up instead of down. And so you have to get that right. Plus, you have to pay the right amount for your option. If you pay too much, the marketplace is going to fight that price. The stock may not rise enough to overcome the high price you paid. So there's a lot going against the option buyer. You can make a lot of money. The chances are good that you will lose, and I don't really love option buying as a strategy. So why would anyone want to sell an option? Selling an option involves more risk than buying an option simply because there's a whole lot of money that can be lost. If you sell someone the right to buy 100 shares of stock at $50 a share, and this stock runs up, let's say, to 70, well, you're going to have to deliver 100 shares at 50, and unless you already own the stock, which makes this less risky, you're going to have to go out and buy 100 shares at this high price of 70, and that's a $2,000 loss. And the stock may not be 70, it may be 100 or 200. So when you sell an option unhedged, when you sell an option without owning another option as protection, and that's referred to as naked selling, not allowed by some brokers, and especially not allowed for new traders with most brokers, your loss can be potentially unlimited. So it's great to sell an option, but you have to understand the risk is that you could lose a lot. But why would you sell an option? Well, you would sell an option because you don't think the stock is moving very far, or you like the premium that you can receive. You're willing to take a chance the stock won't move that far, and you can collect the option premium. Or the most common reason why people sell stock is to adopt a covered call strategy. In other words, you own 100 shares of stock. It's currently priced, say, at 58, and you don't expect much movement from this stock. So you may be willing to sell someone else the right to buy your stock at 60. If the stock goes well beyond 60, well, they'll buy your stock at 60, and you will lose the opportunity to have made a price higher than 60. And that may seem like a bad deal. On the other hand, if you collected $200 or $300 for that option and you got it right up front, and that's yours to keep whether the stock goes up or down, well, you can see that that's a very attractive deal to some people. If the stock goes down, well, you've saved $200 or $300 in losses because you've got that cash in your pocket. And if the stock doesn't go anywhere, well, you've got that cash in your pocket. And if the stock does rise, you still make, from 58 to 60, you still make $200. Plus, you keep the $200 or $300 you got from the call premium. What you don't get is the price above 60. So, sure, someone else may make more than you part of the time, but most of the time, selling an option turns out to be the winning choice, because stocks tend to go down, hold steady, or go up a little rather than go up a lot. So, for the most part, the option seller, when it's covered, makes money. The call option seller makes money. So this is a conservative way to play options. But the point is, it's not for everyone, because some people are very bullish on the stocks they own. That's one of the reasons they own them. So they're not interested in selling calls. So there's reasons to buy options. There's reasons to sell options. And the option markets exist, and they're very popular. There's a whole lot of trading. And yes, options were devised as risk-reducing tools, which is how I hope that you will learn to use them, but they're also great tools for speculators. And in this short video, we've done an overview of what an option is and how it works and how you can get started with options. I don't believe that I've given you anywhere near enough information to go out and start trading, but this is a basic understanding for those of you who came in with no understanding, and I'm hoping that this will allow you to understand more of what we're talking about in other videos, plus in our live sessions where everyone is welcome, and the topics tend to get more advanced part of the time, and I'd love you to be able to at least have an idea of what they're about. I'll also hold special live sessions just for new traders. I want to go back to a topic that I said I would speak of and then omitted. We're talking about learning some new terms. We're going to learn about intrinsic value, in-the-money options, at-the-money options, out-of-the-money options. This is really not complicated. What we're doing is comparing the value of the stock with the strike price. So let's first look at a call option. When a stock is higher than the price of a call option, when a stock has risen above or is above the price of a call option, that call option is in the money. That means if expiration were to occur right now, that option would have value, would have monetary value. It is in the money. I will also tell you that the amount by which it's in the money, and if it's expiration, the amount that it is in the money is the intrinsic value. For example, if a call option has a strike price of 40 and the stock is trading at 42, the stock price is 2 points higher than the strike price. That means the call option is in the money by 2 points and is worth $200, and the intrinsic value is $200. By no means should you be thinking about exercising the option. I don't want to use the wrong term and get you to think that way. But the option has 2 points of intrinsic value. If you were to exercise the option and pay $4,000 per stock, you could turn around and sell the stock for $4,200, collecting $200. Now, that would be a bad deal because the option is probably worth significantly more than $2, and when you exercise, you lose all of the extrinsic value of an option. And the extrinsic is just the total value, plus the intrinsic value. Okay? Not to be confusing, one more time, when a call option is in the money, the amount by which it's in the money is the intrinsic value. Let's look at it from a put option. If you have a put option with a strike price of 80, that means you have the right to sell the stock at 80. So if the stock is 75, well, that put option is in the money by 5 points. The stock is 5 points below the strike price. The option has an intrinsic value of 5 points or $500. That's an in-the-money option. For an in-the-money option, for an option to be in the money, that means that if it were expiration, the option would still have value. When an option is at the money, that means the stock is trading exactly at the same price as the strike price. Since that's very limiting, at the money becomes a loose term, and it means the stock is trading near the strike price. I can't give you a definition because different people will choose different things. If you have a $50 stock trading at a 50 strike price, and it's trading at $49.90, you could call that at the money. It's only 10 cents away. Some people would even consider $49.50 at the money. I wouldn't. But it's a loose definition. So at the money means the strike price is the same as the stock price, and by that definition, it has no intrinsic value. Obviously, if the option is in the money by 10 cents and you choose to call them at the money, then that option would have an intrinsic value of that 10 cents. So that's why we say the definition is the strike price and the stock price are the same and the option has no intrinsic value. An out of the money option means the option has no intrinsic value. For a call option, that means the strike price is higher than the stock price. That means the stock has to move higher still, or has to move higher before that option can become at the money and then in the money. The option has no intrinsic value. It has value. As long as there's time remaining to expiration, there's a chance that that option will move into the money and the stock will rally. So that call option still has value, but it has no intrinsic value. For a put option, an out of the money option is an option where the strike price is below that of the stock. In other words, the stock has to decline in value before that put option becomes first at the money and then in the money. The put option has no intrinsic value. If the stock is 80, an 80 call and an 80 put are both at the money. If you have a strike price of 75, the call option with a strike price of 75 is in the money because the stock is 5 points higher. It has 5 points of intrinsic value. If it's a put with a 75 strike, well, then it has no intrinsic value and is out of the money. And similarly, the 85s, the 85 put is in the money. The 85 call is out of the money. I hope that wasn't too fast, but in the money means the option has value. If it were expiration, it has value even if it's not expiration. But if it expired right now, that option would still have value. That means it's in the money. If it has no value, it's out of the money. And an at the money option also really has no value. So that's the definition of those terms. They are important because it allows us to talk about options. We can speak of in the money and out of the money options, and we know what we're talking about. It's much more complex to say a stock is this and an option is this, and it has to go 3 more points before the stock rises above the strike price, so that means it's 3 points before the call is in the money. It's easier to just say the call is out of the money by 3 points. The stock rises by 3 points. It'll be at the money and then in the money. So those are terms for you to understand. It's not something you have to memorize. They will come naturally to you. But it adds to the discussion to be able to refer to options by using those terms. So I wanted to make sure to include that. This is an introduction to options, and I hope you've enjoyed it. But the one thing I need from you is if you have any questions, if any of this was too fast or moved too rapidly, please, on the page with the link for this video, put your comments, put your questions, and I'll get back to you as quickly as possible. And with that, I welcome you to Options for Rookies Premium, and I hope you're happy with your membership.